Okay, next, document number 4, the commercial promissory note. This is a 5-page document with the promissory note that we have has 18 clauses. It's a very easy to read document and is really the foundation for a loan. It's a promise to pay document that details out the following items. The payment details, meaning the annual interest rate that is agreed upon, the beginning date of the loan, the maturity date means the date that the loan needs to be paid off, the frequency of payments, the and how the payments will be applied. For instance, in our loan, in our promissory note, the payments will apply to any late charges first, and interest will accrue on any unpaid principal. That's a typical clause in a promissory note, but that needs to be outlined. Also, a security. It lets and identifies that this promissory note will be secured by a deed of trust, and that deed of trust will be first priority, meaning outside of the government, that is the first priority in case of any lawsuit. The default clause. A lender may declare the entire outstanding principal due if any of the following things occur. We'll find out that on the next slide. Okay, here's the default clause section of the promissory note. States that a lender may declare an entire outstanding principal balance due if any of the following occur. Well, number 1, failure to pay any installment payment within 5 days of the due date. Number 2, borrower defaults any obligation of the lender. Those obligations are the entire loan agreement. So you'd have to look at all of the loan agreement and look at everything that is obligated or everything that the borrower is responsible for. Okay, so that's why it's very important to outline an operating agreement to discuss everything that will be done and every commitment that will be done in the project. So you have those commitments as well as the commitments on the borrower and guarantor certificate along with the promissory note. Okay. Next, if a default occurs where the borrower sells, leases, or disposes or the property gets damaged, that's considered a default if the payments aren't made. Okay, so the borrower sells property and doesn't pay it off, that's a default. The lender can demand their money and will demand their money immediately. Another situation, a borrower becomes insolvent, has financial issues, filed bankruptcy. A lot of times, lenders will be looking at court documents like divorce documents and stuff like that, bankruptcy filings, and if your name or the managing member's name appears, the borrower is within their rights to incur and ask for your financial records, check for your solvency and your capacity to pay. And if they're not comfortable with your capacity, they can ask for their outstanding principal back immediately. And if the borrower dies, okay, now in our situation, the borrower is the LLC, okay. Now, the managing member is the supervising figure of the LLC. So if that member dies, that it would be the point where the lender may declare the outstanding principal balance. Okay, now look at this default rate. 22%, 22.9% was the default rate, meaning the interest rate that has to be paid on things that are late. That's an incredibly high interest rate. But that's within the legal limits, and that is what the lender would agree to. Now, of course, this prepayment is it's an important clause as well because what it states is that the borrower may prepay all or any portion of this at any time. Okay, and there's typically a repayment clause as well where it states that you can repay at any time, but I don't recall that being in there. But we'll see later on in the presentation. Okay, here's some additional clauses within the promissory note. The payment past maturity clause certifies that the lender has the sole discretion to accept payments that are past due, past the maturity date, meaning past the date of when this loan should have been paid off. But this clause makes the borrower agree to authorize the lender the ability to initiate an ACH direct debit transaction from the borrower's account. So the borrower fails to repay the loan back at the maturity date, the lender is then authorized to direct debit transactions out of the borrower's bank account until the loan is paid off. Late charges on any installment, so any monthly payment or whenever the installment date is, will be 5% of the installment and will be applied 10 days after the due date. Lien and set off. Okay, the borrower will give the lender a lien on this transaction. Okay, so this commercial promissory note will be a lien recorded against the property. And it also states, which is very important, the purpose of the loan. And this must be a business and a commercial only. No residential. You cannot use this loan to buy the property and live in it. It has to be for commercial purposes only, and no agricultural purposes. There were several clauses, several sections where the lender mentioned no agricultural purposes. So I guess on this loan you can't grow any marijuana or whatever. Okay, additional clauses to the promissory note. Waiver and governing law. This clause states that the borrower waives rights to a hearing and trial under the state statutes in case of default. We talked about that earlier. They want to be able to move along without having to go through the slowness of the government court system. They want to be able to, if in case of default, exercise their option to seize the property and go on about their business. This document also defines what a maximum rate is. As you saw previously, that 22.9% interest rate for in case of default was extremely high, but that's still underneath the usury law, which I believe is 29%. So it's still legal. 23% is legal to charge someone interest because it falls under the usury law rate. Severability, okay, that you will find that in all of the indemnity clauses and indemnity agreements in the contract. But basically, severability is it basically states that if any term or clause is deemed to be invalid or unenforceable by the courts, that does not disqualify the entire contract. The remaining clauses of the agreement shall not be affected and shall be enforced to the terms of the agreement. So just because one section or one particular line in the contract is not enforceable, it does not cancel out everything else. So that's what the severability clause is. And termination fee. No termination fee will apply to this payoff of this loan. Some situations, lenders want you to stay and pay for the entirety of the loan term. Well, hey, if you can pay it off before the 12 months or the 18 months or the 5 years that you have an agreement, um, I don't feel like you should have to pay a termination fee. And in this particular promissory note, that clause is stated. Okay, now let's go over the fifth document, which is the commercial loan agreement. Now, this is an 18-page document with 7 articles. I was confused between the promissory note and the loan agreement, particularly why do you need both? But I found a definition from Millie Johnson from Rocket Lawyer that kind of explains the difference. Okay, quote, both loan agreement and promissory notes are legally binding and enforceable. Um, they both set out terms for repayment of debts. However, a loan agreement normally contains specific and stringent terms. In other words, more detail, with greater obligations and restrictions placed on the borrower. It also often includes elements of security, i.e., putting up a house as collateral or some type of security instrument, whereas a promissory note typically is unsecured. So, if in this situation we had both, we had a promissory note that explained the terms, and then it was followed up with a loan agreement that collateralized the loan. Okay, as I said before, the commercial loan agreement is much more detailed than the promissory note, and here are the details within. So, Article 1 discusses the loan. It goes in detail as far as the amount for the lender's non-refundable fee, prepaid interest, service fee amounts, processing fees, lender legal fees, which we discovered we were actually liable for, and insurance fees. Now, these insurance fees were not like fees to pay an insurance company. This is for fees where the lender needed assurance on the loan. So the lender actually held back 1% of the loan in an escrow as insurance on the loan, which I thought was very interesting. It also details the interest rate of the loan. Um, it also promises that these funds will be released in case, if as long as there's no default. It went over the construction advance that would be provided to the borrower. So we were doing a rehab deal, rehab real estate project, and in our agreement, 70% of the loan amount would be delivered to us at the closing table. And then 20% of the loan amount would be held back as a construction holdback loan. So as we got further along in the rehab, we would have to request the funds and go through that process to receive some of that construction holdback. The article also details out the start dates and maturity dates, the default terms, which are similar to the default terms that we've discussed before. It also went over the process for requesting advances and requesting construction funds. And within that request, the lender has the right to require government inspections and certifications and sign-offs to accompany the request, and any type of permits that are required in the renovation that would need to be submitted along with the request for the construction funds. The article also states that the lender is not obligated to make the loan unless all obligations in the closing docs have been deemed satisfactory. Okay, Articles 2 through 5 were pretty brief in the loan agreement. Article 2 was the representation, warranties, and covenants article, which stated that the borrower certifies that the type of entity and legal structure is compliant and legal, and that there are no defaults or litigations that currently exist with the project or the property, and that the taxes have been filed properly, and that the members of the LLC are solvent, financially capable, and not in a bankruptcy status. Article 3 was the affirmative covenant, and it basically certifies that the borrower will make payments on time, perform fully to all of the terms, all of the renovations, all of the legal requirements, all of the agreements in the overall agreements, and that the borrower will stay legally compliant, keep the property insured, and will complete all improvements and renovations in accordance to the scope of work and the budget that we had to present to the lender prior to getting approved for this loan. Article 4 and 5 are the negative covenants and the default articles. We've gone over defaults a lot, but this certifies that the borrower will not consolidate, merge the entity. So they're not going to allow our LLC to be acquired or to merge with another LLC or another entity while this loan is still unpaid. If it's discovered by the lender that ownership has changed in any way, the lender has that right to call the loan due and ask for the funds in total. Okay, now let's discuss the final sections of the loan agreement. Article 6, 7, and the schedules. Article 6 is the indemnification clause. Okay, we've gone over this before, but basically it's stating that the borrower shall hold the lender harmless against any claims, demands, judgments, or losses in regarding to the project or the property. If the lender has to pay any of these, any fines, any claims, the borrower must reimburse at the specified interest rate in the loan agreement. Article 7 is the miscellaneous article, and you will notice in a lot of these documents that there's a section or a clause for miscellaneous, and you have to be real careful because there's a lot of words, very legal terms. So you definitely want to make sure that you read over these miscellaneous terms and have a legal representation interpret it if you need so. But this article includes a waiver to trial. Oftentimes in these miscellaneous clauses, there will be a waiver to a jury trial. These hard money lenders do not want to tie this thing up in court. Time for payment may be extended or changed as stated in the deed of trust. I mean, typically these lenders are used to doing real estate projects, and they know that there's cost overruns, there's time delays, there's material issues that can cause everything to get delayed. And as a consequence, sometimes the payment can get delayed. So it is good that there is a clause that will allow for extension. But again, those are on the terms of the lender. And also it states that the lender has the right to assign the agreement. So, in cases sometimes if something drags out and payments get delayed, the lender may sell their interest in that loan to another lender so that they can go ahead and get out of the deal, get paid some of the money, and then move on. And then you'll have to deal with another lender. So lender has the right to do that. And, according to this loan agreement, the borrower has to agree that any rights that pass through to another lender, you're obligated to the right that you agreed to, regardless who the lender is. Schedules A and B. Schedule A was a draw request form. And it basically was a form that certifies that the borrower is using the funds for the stated purpose and that the borrower will submit true, accurate, and complete copies of any invoices, receipts, of any work that was done by a subcontractor. So when the request for reimbursement or request for construction funds is submitted, those documents have to accompany the request. Finally, Schedule B is another representation and warranty clause, but it's in regarding the deed of trust and basically certifies that there's no outstanding charges or liens. And a lot of times what this can be referencing is that if you are the general contractor or have a general contractor that is responsible for the renovation of the project, that general contractor has to make sure that all subcontractors that are doing the work get paid. If not, those subcontractors can put a mechanic lien on the property. So this warrant certifies that there are no charges or liens at the time that you request funds, and also at the time of this agreement. It also identifies the accuracy of the property description and location. Oftentimes these lenders are out of state, so they're never going to step foot on the property. So they just need to verify that the property description and location is accurate and that their lien is the first position. So if something goes bad, they get the money first.